Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Stephen, welcome back to the podcast series. It's great to have you on.
Great. Thank you, Owen. Thanks for having me.
Many of our listeners will be familiar with you and Aoris and your international fund. People who don't know, I should give the introduction to you. You're the founder and Chief Investment Officer of the Aoris International Fund. We've done an episode together in the past, which was this longer form interview where we dived into your investment process, portfolio construction and business. In this episode, we're going to take a bit of a different tact and we're going to focus on an individual company. And this is something that's been requested from our listeners. They said to me in a questionnaire, we really like the guests, such as yourself. It'd be great if you could have them back on to talk through an idea. And I know you've got some great ideas. And what makes you so unique and the fund that you've set up so unique, it's concentrated, you back yourself, your business first. So it's a really interesting discussion. But not only that, you also share your research, or at least some of your research, and provide in-depth commentary on every company in your portfolio on your website. So people, if I'm not mistaken, Stephen, could go to your website, see the companies that you hold, correct?
They can see not only the names and logos of the companies in the portfolio, all of them, but if you can click through and you can see a brief description. So some of those names will be well familiar with people, and Nike being a good example, others less familiar. And with about half or 2/3 of the stocks in the portfolio, we've even got a short corporate video which can really bring to life visually what some of these amazing businesses do. So I'd certainly encourage people to visit that insight section of our website to explore the portfolio a bit more.
Yeah, I'll put some show notes in so people can go directly to it. And I think it's great because if you're an avid investor like I am, you can jump on and see what a great investor such as yourself is buying and the research your team is doing. And you can do that with almost full transparency, which is fantastic because, some of the larger funds don't disclose all of their, or when I say larger, I mean more holdings, they don't disclose all of their positions. So it's a bit of a mystery sometimes what else is in the fund, but with you can just see it all, which is great. Before we get to the company or stock that we're talking about today, I thought I'd just highlight something that came out of your most recent quarterly report from the June quarter. And in it, you talked about some of the headlines that we've seen in the media recently with the coronavirus crash and then subsequent recovery. There's a lot of people saying, there's bargains to be had. There's other people saying that, it's risen too fast, too soon. I'm interested to get your take on this and whether you agree or disagree with any of those points of view and how you're kind of seeing things at the moment.
I guess it opens up a whole interesting box of what investing is all about, and I think there's some common misperceptions. One that through owning shares, you own a piece of the economy, and the fortunes of what you own will move in with a high correlation to the economy, and I think that's simply not true, and the evidence would suggest that's the case. Unless perhaps you own highly cyclical businesses, very much fair weather businesses like a cement company or a steel business or a bank perhaps. Their GDP and the vicissitudes of the economy really will matter. I think the other thing it's useful to think through, well, if I own shares or a managed fund or an individual share, do I own the whole equity market? And we certainly encourage people to think that a share is exactly that, a share of a business. And so to try and peel back the layers when you own a fund, you don't own the equity market in aggregate. Unless, of course, you own an index fund, which of course you do. But if you're not an index investor, then you're an active investor. And if you're an active investor, you own businesses. That's certainly how we think about it. You own a claim on the fortunes, the value creation of individual businesses. So I think now's a great time to be thinking like that. Not all the businesses are the same. Not the fortunes, the long-term value of the businesses are not defined by what happens in 2020. But you certainly want resilient businesses that can not only survive but thrive through these testing periods, and it certainly will separate the great, the good, the average, and everyone else.
Yep.
That's very much our mindset, and I think it's a useful one to have, to remember that by owning equities, then you own individual businesses.
I think particularly too, it's important to highlight that we're talking about, if you're a long-term investor here, you benefit from the business and the growth of that business and the internal economics. And one of the things we're going to get to with this company, I'm sure, is I guess just the attributes that go into creating such a fantastic business and compounder. And I shouldn't delay anymore, Stephen. But the company that we're going to talk about in this episode is Accenture. People may know it. I mean, I imagine most of the professionals that listen to this will know it. Many investors, chances are, will know it. It's a $150 billion company, so it's quite a large business. But maybe I'll hand it over to you to explain, I guess, the backstory of the business, a bit of the history, what it does today, and then maybe even how you came across it and what you found so appealing.
Oh, sure. Okay, look, it's an exciting one to unwrap. Let's open the box and talk about a wonderful business. Well, certainly in recent years, before 2020, if you'd walked through most airports in the world, you would have seen signs to Accenture. The longer-term corporate history goes back to when they were part of Arthur Andersen. Some people may know it's an unfortunate corporate tie, if you like. But Accenture, the accounting and consulting and IT business, they separated from the broader Arthur Andersen business before the Arthur Andersen folk ran into a lot of trouble. So what Accenture today is the world's largest IT outsourcing and consulting business. And let's sort of talk about some of the things that define the business, some of the things that makes it a really interesting business, and then we can explore it in a bit more depth. Accenture provides their services really to the Global 2000, as they describe it, which means the world's largest private and public sector and not-for-profit organisations. And if you are thinking, if your business or mine or many small businesses were to look for some IT help, well, there's basically a phone book of people you can call or a long Google search. Who can help me? But as you get larger, there are fewer people that can do the job, and that's a huge advantage for Accenture. If you're Toyota Motor Company, or if you're Unilever, or if you're the US Department of Health, perhaps, then how many people can you call? Well, it's not that many. So 75% of the Fortune 500 do business with Accenture. 95 of their 100 largest customers have been customers for more than 10 years. So not only these durable relationships, and not only do they have broad presence with the world's largest, most demanding organisations, but they're also very deep relationships. And one way of measuring that is, well, how much do the big customers spend with Accenture per year? And they have about 200 customers that they define as diamond clients that spend 175 million US per year with Accenture. So you can just get a sense of how much Accenture does these businesses and why they are very deep and long-lasting relationships.
It's an interesting business, because I look at it and I think of the traditional moats that we think about: intangible assets, economies of scale, intellectual property. There's so many things, which I'm sure we'll get to in a moment. But maybe if we could go one step down from, okay, so that's we know what it does. What are the different, I guess, segments in the business? And I guess why would a large blue chip client come to Accenture specifically? Like, what problems would they be solving?
Well, I think a key word I like to use with any business, and I think it's very, very important with Accenture, is relevance. And I think what made Accenture such a good business is that they have constantly evolved over the last 2 decades, say, to stay relevant to their customers, solve today's needs. And I think they've done it in a way that their larger peers simply have not done. So if we go back 10 or 15 years, Accenture might have been hired to do a huge SAP implementation. What we're going to do is replace a whole lot of IT, put in a really modern SAP or perhaps an Oracle system, take a whole lot of costs out and outsource it to Accenture's operations in a lower cost country. But if that was all that they were doing today, it would be a lot less relevant business, a lot less valuable. And some of their peers have never really evolved from that. And Accenture has evolved, and it's been really the rallying cry of the company over the last 10 to 15 years, is rotate to the new. And that means digital, it means cloud, it means cybersecurity, it means all of the today's contemporary IT needs. It might mean creating e-commerce capabilities for a retailer, perhaps, or a manufacturer. It might mean enabling secure work from home environments. But impressively, they've been able to achieve that rotation without doing two things, without either abandoning what they used to do. Of course, we'll still do big cost lift outs and SAP implementations if you like, but they can do that very cost efficiently so they remain competitive in those legacy services, if you like. And secondly, they've been able to transform iteratively without doing, if you like, a transformational acquisition that so often blows up. And that's where, if you like, some of their peers, they slip behind. Okay, we're now going to throw the Hail Mary pass, a big transformational acquisition to try and catch up, and really so often it doesn't work. So Accenture's constantly impressed me by the iterative rotation to the new, which now all of those new services account for about 3/4 of revenue. And that comes from hiring people with relevant skill sets. And of course, that's a very competitive marketplace, retraining tens of thousands of people a year so that they can evolve their skill sets, and making lots and lots of small acquisitions that might bring groups of people that have very relevant skill sets. So that's one way of thinking about why is Accenture going to be the go-to outsourcing and consulting company when in one of these very large global organisation needs help. And the other thing why Accenture does so well is that it has a very broad offering, and we can, if you like, Rubik's Cube that, if you like, with slice and dice. What does broad mean? Well, broad means they operate in 180 countries, and increasingly the world's largest organisations are global. Volkswagen doesn't just do business in Europe, and Unilever doesn't just do business in one country. So, by the way, I've got a global organisation, are you global? And we don't want a patchwork of IT firms to help me in different countries. We want someone to be global. So that's number one. Number two is that they do it soup to nuts, if you like, all the way from consulting. Will come in and diagnose your problem and create a solution, and then build or implement the IT solution, and then run it for you if that's what you like. So they're being able to do that end to end. And the third dimension in which they have this very broad offering is right through an organisation. And increasingly, organisations don't want to just transform a slice of the company; they want to transform everything. And so, if I've got to take my HR to the cloud, maybe I've got to do the same on the manufacturing IT. Maybe I've got to create cybersecurity in one part of the business. I've got to do it in everything. So their breadth across services is, and probably a fourth dimension, if you like, is that they do it for so many industries. And increasingly, companies don't want to just take best practices from their own direct peers, but maybe there's someone else in, if I'm an automotive company, I don't want to see what the best automotive company is doing. I want to see what the best telecommunications or the best engineering business is doing in an IT area of my business, that we might pinch the world's best, not best in my industry. And that's another, if you like, a fourth dimension where Accenture's breadth adds real value and relevance to their customers.
It's a business, I think, which goes, unless you're specifically looking for wide moat businesses, you might think, it's a services company kind of thing. It's expensive. There's a lot of labor, all these types of things. But when you look a bit deeper and you scratch below the surface, you can see that, these are really sticky clients. These businesses rely on Accenture to handle complexity and do it at scale, like you said. I'm interested to know, Stephen, because it's such a large business, $150 billion market cap, how do you and your team go about, I guess, doing your own boots on the ground research or getting it, what we would call maybe an edge, quote, that's air quotes, an edge, over other investors who are looking at this business? And maybe you could take us through some of the unique due diligence steps you took.
Look, that's a great set of questions about how do we see it, or where's our diversion perception, if you like, what's the rest of the market missing? I would say also that, look, change is inherently good for this business. If the world doesn't change, then they need less of what Accenture provides. So the world's changing a lot at the moment, and that keeps the company relevant, but there's never a period where the world just stands still. And the other thing that's helpful is that they're IT agnostic. If you want Microsoft's Azure to take your business to the cloud, absolutely. If you want Amazon Web Services, that's fine. So I think being the arms dealer is a great place to be, being supplier agnostic. So in terms of the things that we look for that, I guess, validate our hypothesis and ways in which we might see it differently, we certainly pay a lot of attention to organic growth. Are they doing more things with their existing customers? Are they winning more customers? that's a validation that the business is relevant to its marketplace. And if their market share slips, well, that would be a very deep red signal. Are they staying true to their iterative renovation and rotation to the new, or are they now throwing these big Hail Mary passes? That would be another red flag. Are they suffering from the price decay or the price competition that might be a signal that what they're doing actually is not that special anymore? Or are they being able to charge a lot for their services? Is it just a rent-a-person model, or are they able to grow their revenue per person, which would be another sign that actually it's not IP-rich service. So those are the things that we pay a lot of attention to. In terms of how I sometimes maybe the market underestimates what's in front of their eyes, if you like. That it's sometimes Accenture's over many years grown organically, which we mean in the absence of acquisitions, about 2 times the rate of the broader economy or the rate at which their end market grows, and that's pretty exciting. But maybe while people get enamored with the 15-20% growth rates of some businesses, 7 or 8% growth doesn't seem that exciting. But it's very cumulative over time. It does pretty amazing things, particularly when it's profitable growth. You're not having to take a fast-growing but unprofitable business and make big assumptions about what might come in the future. It's also a very conservative business. They run with cash on the balance sheet. Their management team is very long tenured. We might say, well, a people business, all the assets go out the elevator every day. But of their top 5,000 people, have an average tenure of 15 years with the business. It gives you a sense of, well, people come here and stay a long time and build their careers at Accenture. So I think the ability for them to continue to compound profitably at that rate and reinvest capital, maybe it doesn't have the magic appeal of an e-commerce business or an enterprise or a exciting, as we speak at the moment, a work-from-home beneficiary, if you like, that gets the market very, very excited. But that's fine. We can look back over a long period of time and see the business has done what we expect, done what they promised, and we don't have to make heroic assumptions about what the future might bring to feel confident that they're going to continue up this very attractive wealth creation path that they've been on.
There's so many things that we can talk about, Stephen. Unfortunately, we've got limited time. But one of the things that I wanted to touch on was, I guess, the transition to cloud-based resources. So you mentioned there that the business is almost, it's agile, but it's still a blue chip business in itself. So my understanding is that the business can take, like you said, it's agnostic. It can take AWS software, it can take whatever, and it can put that into its consulting contracts and projects that it works on, and then it can outsource, I guess, the automated part of that to other countries where maybe there is still some labor required. How do you think about it? And shifting gears here to risks. How do you think about it in terms of the longer term runway of that? Do you think Accenture succumbs to, I guess, commoditization as more companies move to the cloud? Once they're there, kind of what more can you do for me, Accenture? Is that a fair and reasonable risk, do you think?
Yeah, look, it's a great question. And I think what the company's done, or one of the many things they've done well, is to continue to grow into more spending pools over time, that we're not just after your IT budget. There's more things we can do for you, and that makes us more relevant. And a good example of that is over the last decade, they built the world's largest digital advertising and communication business. And you might think, well, WPP and Omnicom and the likes, they own that market. Well, Accenture has built a $10 billion a year business through organically and buying lots of businesses that have been very successful, and they piece that together. And they might say to a Hyundai, well, look, your advertising communication is increasingly digital. You want customers to be able to go online and build their own car and order it from you, or a retailer. You need an e-commerce proposition, and you need to be able to communicate that digitally. So Accenture has grown into that. That's a $10 billion a year out of a $45 billion revenue line for the company. It's 20% of their revenue. It's very meaningful, and they're now. When you say, well, what else can we do for you? That's been a big answer to that. And now they're doing increasingly all the software and IT that goes around manufacturing, and they call it, I think, Accenture Operations 2.0. So increasingly, as things on the factory floor get connected to a, if you like, a central hub, then the security around that's important. The data retentions around that's important. So Accenture's growing into another revenue pool. Not only does that provide revenue growth, but it also helps to drive the point of engagement with the business higher up. So if I'm just, if you like, solving IT needs, then there's a risk that I go from pitching to the CEO down to the chief technology officer, or at worst the procurement guy, because all he wants to talk about is price. But if I'm doing more and more relevant things, and I'm doing things outside of IT into manufacturing and communications, then it's a CEO level conversation. I'm relevant to the board of directors. So they've done. That's another way that their relevance has been an asset. It keeps them important at the very highest level of their customer organisations, and grows their revenue pool into multiple dimensions.
How about when it comes to valuation? Because valuation is I guess the balance between risk and reward, or potential reward. How do you think about the valuation of the business? What kind of work did your team do in that respect?
Yeah, well, I guess when you think about what's this business worth, some of the considerations would be, well, how much capital does this business need to grow? And the nice end of that is none, because their customers pay them in advance. They don't build factories, so it's a very capital light business. The second thing is, how risky is this business? So that will inform the multiple that we apply to those each dollar of cash earnings. And when we think about the balance sheet, we'd say, well, they don't have any debt, so we'll call that a low risk balance sheet. When we think about management, are they disciplined, judicious in how they run the business and allocate capital? We'd say, well, they're a low risk management team. And then we think about the business. Is there signs of slippage here, or are they continuing to do a good job of stay relevant and grow market share? So is it a low risk or a high risk business? And so across those three dimensions, then we come up with a positive appraisal of Accenture as a low risk entity. And then we turn our attention to growth, and we'd say, well, is this a business that can grow a bit faster than the market? And how much is that worth? And all of that tells us the business is worth a premium to the market. We'd say a substantial premium, but we think that premium makes sense when we think about risk and growth. And then the other, I think, important consideration to that is, well, a dollar of earnings or a dollar of cash flow is only worth what the company does with it. It's until they pay it as a dividend, they've got it. So are they at risk of turning it into something less than a dollar by investing it in low return projects or acquisitions, which happens all too often, or actually more likely to reinvest it intelligently back into the business, or acquisitions that actually enhance the value of the group? And so that the capital recycling or reinvestment, or what management does with a dollar of cash question, we feel very good about the answer to that, and their ability to grow profitably and reinvest capital at high rates of return.
So when you look at that, Stephen, if we could pinpoint a few metrics here, are you looking principally at things like return on invested capital?
We do look at return on invested capital, and we look at how stable it's been over time and what direction is it going, as a bit of a clue to, as a company reinvest capital, are they getting more than what the business was generating last year, or less than? And how important is that to management, or is management predisposed to get big quick, if you like, and do a big acquisition that so often ends in disappointment? So the return on invested capital is very important. The ability of the business to reinvest it in high rates of return, and all of the ingredients that sort of preserve profitability, pricing power, and their ability to be engaged in highly relevant IP-rich projects that are indicative of the preservation of the high returns going forward, are all important soft and hard metrics for us.
Yeah, I did some crunching the numbers, and I look back over time, and I can see that just over the past 5 years, Accenture's been able to maintain return on invested capital between 40 and 50% each year. And which, when you think about that, that's as a metric that I tend to think about quite often. that's a signal that there could be something here that's worth digging a little deeper into. Stephen, as we come to the back end of the pitch, if you like, how do you think about position sizing? So when you initially got this idea, it went through the investment process, you went through the process with your team. How do you then think about position sizing and moving into the company to build a full position?
Yeah, look, it's a very interesting question for us. As you touched on earlier, we run a concentrated portfolio with a maximum of 15 stocks. And the other thing that's very much hardwired in for us is that we don't time the markets. We don't take cash to low and high levels depending on about how we feel about the economy or markets in general. So across our $100 of investable capital, an average position size is going to be 6 to 7% with 15 positions. And so for a business like Accenture, we're comfortable having it today as, if not our largest, among our largest positions. And we do have a maximum, a hard ceiling of 10%. So we can't have it larger than that. Accenture is very close to that 10% limit today. And that's a function of our confidence in the business's ability to continue to get more valuable. Ultimately, we talked about at the beginning, well, what are you, if you own shares, what do you own? Well, we want to own businesses that become more valuable, where the risk of a disappointing outcome is low. And on both those questions, we feel very good about Accenture. And it's a wealth-creating machine. You mentioned those high returns on invested capital. That's the foundations for those are all those attributes we talked about that make it a very special business. And then the risk of competitive slippage or a very disappointing outcome, we think is low. And then we feel good about the valuation. Absolutely, it trades at a premium to the market. But the question to us is, does it trade at a premium to what it's worth? And on that score, we feel good about how it's priced today. So for those reasons, it sits at the very highest end of our portfolio weights.
Just one little thing to tuck on the end there. When you think about the ideal time horizon for holding a business, and maybe even reflecting now on the fund so far, what's your view with when you start a position? Typically, how long would you like to hold it ideally?
Yeah, well, on the we balance price. We also balance our disconfirming evidence. So if a business is not growing or showing the signs of the quality criteria that we look for, then we don't waste time in taking it out of the portfolio. And we know that at any given point in time, there's businesses that in the future the competitive position will erode, or management might turn out to be not as judicious as we thought. But for a business like Accenture, we'll typically start a position for us at around 4% of the portfolio, and over the course of the year, build it higher, price permitting, as we, if you like, get validation through the company's earnings results and our interactions with the company. And for a business like Accenture, look, we wouldn't be in a hurry to take a position out of the portfolio because we'd be happy to own it for a very long time, just because it has that nice, unusual combinations of underlying growth well in excess of the economy, a conservative management capital structure, the ability, if you like, there's various tailwinds that are making the business even better, more valuable. Large global organisations want to deal with fewer suppliers, so Accenture's in a good position as they think about, well, like I won't just use my Nordic IT supplier. I want a global IT supplier, and I want to re-engineer the IT not just across a slice of my business, but across everything. So Accenture sits on the right side of all of those structural changes or all of those directional changes. We like to own positions for multiple years, and Accenture has all those nice attributes that make it one that we're likely to continue on for multiple years.
Yeah, great. I think that's a wonderful overview of Accenture, Stephen, and the business case, and I guess the thesis behind it. I know that our listeners can go to your website, Aoris AM, I believe, to go and get more of, I guess, your latest thoughts and to follow along with monthlies and quarterlies. Is there anywhere else or any other places that you would direct our listeners to?
Look, to read about a business like that, I'd always direct them to the annual report of the company and hearing how the company speaks to them. The chairman's letter in particular is always an important source of your due diligence. It's always the first stop, if you like. And to hear more about us, Aoris, aoris.com.au is a good place, and hopefully there's some material that's relevant to what people would like to discover about us.
Yeah, fantastic. And I'll put the links in the show notes to that. Stephen, as always, thanks for joining me on the show.
Thanks, Owen. Thank you so much.